Right now, tonight, while you're watching this video, someone on Wall Street is counting on you to do exactly one thing: panic. That's it. That is their entire plan. And if you hit play on this video, you just made their plan a whole lot harder to execute. Stay with me for the next 16 minutes because what I'm about to show you is going to completely change the way you look at what happened to silver today, and more importantly, what is about to happen tomorrow. Welcome back to Silver Trends. If you're new here, you picked the single most important night of 2026 to find this channel, and I need you to do one thing before we go any further. Hit that subscribe button and turn on the bell notification right now, not at the end of the video, right now, because tomorrow's Federal Reserve announcement is going to move fast, and you cannot afford to be behind. And if you've been here before, if you've been watching this channel, if you've been following this story, you already know what I'm about to say. You already felt it in your gut today when you watched that number. You watched silver get dragged down to $79.57, and you felt something. Maybe it was fear. Maybe it was confusion. Maybe you almost reached for the sell button. I need you to stay right here because I am going to walk you through every single piece of this, step by step, number by number, and by the time we're done tonight, you're going to understand exactly what was done to the silver market today, who did it, how they did it, and why tomorrow's Fed announcement could be the moment everything flips violently in the other direction. Let me paint the scene for you because context is everything, and the mainstream financial media is not giving you context tonight. They are giving you fear. It is Tuesday in March of 2026. The paper price of silver opened this morning in a world where Middle Eastern oil fields are sitting under active military threat. $95 crude is sitting on the tape like a loaded gun pointed directly at the consumer price index. The Federal Reserve has not cut rates in 3 months, despite every single economic indicator screaming that the growth engine of the American economy is starting to seize. And this morning, behind closed doors in a conference room in Washington, D.C., that you and I will never be allowed inside, the Federal Reserve began its 2-day monetary policy meeting, the most critical FOMC gathering of the entire year, maybe the most critical of the decade. And what happened to silver on the exact day that meeting started? It got taken to the woodshed, 79.57, bleeding. Down. While Bloomberg anchors smiled into the camera and told you the US dollar was the last safe haven on earth, while CNBC put the word safety in the chyron next to a picture of the greenback. That specific, coordinated, perfectly timed narrative, that is the crime scene I am standing in right now, and I want to walk you through every inch of it. Here is the thing that makes what happened today so infuriating, so transparently manipulative when you actually look at the numbers. The media's argument, the stated justification for why silver should be going down today of all days, is that high oil prices will force the Federal Reserve to keep interest rates elevated. And elevated interest rates are bearish for precious metals because they raise the opportunity cost of holding a non-yielding asset. That is the argument. That is what they sold retail investors today. And on the surface, if you don't look too closely, it almost sounds reasonable. Almost. Until you realize that the market has already priced this in completely, exhaustively. Going into this FOMC meeting, the federal funds futures market, which is the market where institutional traders actually put their money where their mouth is, not where they put their television commentary, that market had already priced out approximately 50 basis points of rate cuts that were originally expected for 2026. 50 basis points gone. The most bearish possible interpretation of the Fed's position, rates on hold indefinitely, no cuts, maximum restriction, is already sitting inside the $79.57 price you looked at today. The market did not price in cuts. The market priced in zero. It looked at $95 oil. It looked at the Middle East conflict. It looked at the CPI data from the last 3 months, and it said the Fed is trapped. That adjustment already happened. It is done. It is baked in. So when the media runs a fear story tonight about a risk the market already incorporated weeks ago, ask yourself who benefits from you believing that story is new information. Ask yourself who is on the other side of the trade if you sell tonight. Think about the asymmetry of what I just said. If the worst case, no rate cuts, rates on hold permanently, is already in the price, what happens to silver the moment the Fed delivers anything better than the worst case? What happens when Powell walks to that microphone tomorrow afternoon and says anything at all, that suggests the door to future rate adjustments is not completely and permanently shut? The answer is what traders call a V-shock. And I want to explain this carefully because I use this term constantly, and I want every single person watching Silver Trends tonight to understand the exact mechanics of what we could be watching tomorrow. A V-shock is a violent, algorithmic, nonlinear price reversal. It is what happens when the automated trading systems, the algos that now execute the overwhelming majority of volume on the COMEX paper silver market, systems running at microsecond speed that are not operated by a human, sitting at a desk, but by decision trees and if-then logic chains. When those systems are positioned heavily on one side of a trade and the fundamental input that justified that positioning suddenly changes, they do not gradually unwind. They do not gently rotate out. They flip simultaneously. All of them in the same direction at the same time, because they are all reading the same Fed statement. They're all parsing the same Powell press conference through the same natural language processing algorithms. And when the words do not confirm the worst case scenario they positioned for, when there is even a single sentence of dovish hesitation, even a single acknowledgement that the geopolitical situation is creating economic headwinds, the V-shock begins, the dollar dumps, silver gaps up. The algos that were short get margin called and their buy orders to cover add fuel to the move. It is self-reinforcing. It is violent. It is the exact opposite of what you're being told to expect tonight. And here is where I need to bring history into this room. Because you cannot understand 2026 without understanding what happened in 1971. In August of 1971, Richard Nixon stood at a television podium on a Sunday night and told the world that the United States would no longer exchange dollars for gold at the agreed rate of $35 per ounce. He broke the Bretton Woods Agreement. He untethered the world's reserve currency from physical reality. And the stated justification? Inflationary pressure, international demands for gold redemption straining treasury reserves, a war consuming resources, and creating fiscal deficits. Sound familiar? Replace the $35 gold window with the current dollar system. Replace Vietnam with the current Middle East conflict. Replace 1971 inflation with 2026 stagflation. The architecture is identical. And what happened to silver after 1971? Silver went from approximately $1.50 per ounce in 1971 to $49.50 by January of 1980. That is a 33-fold increase in 9 years. Not 33%, 33 times your money. Then 2008. The financial system's addiction to rehypothecated mortgage debt collapsed and silver dropped briefly and violently in the liquidity cascade of October 2008. Exactly the way it is, dropping briefly and violently right now. And then it went from $8.40 in October of 2008 to $49.51 in April of 2011. Nearly a six-fold move in 2.5 years. Then 2020. March of 2020. The COVID crash. Silver got taken from $18 down to $11.64 in a single week. The media told you it was over. The financial press told you the dollar was the only safe haven. And then, I need you to remember this, silver went from $11.64 in March of 2020 to $29.24 by August of 2020. 5 months. From the bottom of the manufactured panic to nearly 3 times the price. In 5 months, every single time. Every single time the pattern repeats. And you are standing in the middle of that pattern right now, tonight, watching 79.57, and they are telling you to sell. Let me give you the math on why the situation is fundamentally different from any normal rate environment, and why the media's 3-step logic chain completely collapses under scrutiny. Their argument goes like this. High oil prices equal higher inflation. Higher inflation forces the Fed to keep rates elevated. Elevated rates are bad for silver, therefore sell. 3 steps. Every single one fails. Step 1. High oil prices equal higher inflation. True in the short term. Also true in the short term that high oil prices destroy consumer spending, reduce corporate profit margins, increase input costs across every manufacturing sector, and function as an enormous tax on economic growth. $95 crude is not just an inflation input. It is a growth killer. It is a stagflation generator. And stagflation, the simultaneous combination of stagnant growth and persistent inflation, is the specific economic environment where the Federal Reserve has the least ability to respond. Because interest rates cannot fix both problems at once. If they raise rates to fight inflation, they crush growth further, push unemployment higher, risk a deflationary debt spiral, and increase the cost of servicing $37 trillion of federal debt at a rate that becomes mathematically unsurvivable. If they cut rates to support growth, inflation runs hotter, energy costs spiral further, the dollar weakens, import costs explode. There is no clean answer. There is no rate decision tomorrow that solves the problem. The Fed is in a box, and the institutions that run these algo systems know it. They know the Fed is trapped, and they are using the fear of tomorrow's announcement to quietly, methodically accumulate the exact hard assets that protect them from every possible outcome of a trapped Fed's decision, while retail investors panic sell at $79. Now I need to talk about something that most precious metals investors, even serious ones, do not fully understand, and that is the repo market and the role it plays in the price you see on your screen. The repurchase agreement market, the repo market, is where large financial institutions go to borrow short-term cash, overnight, or for a few days. They pledge collateral, typically treasury securities, and they get cash in return with an agreement to repurchase the collateral the next morning at a slightly higher price. The difference is the repo rate, the effective overnight interest rate. In normal functioning markets, the repo rate is stable, tracks the Fed funds rate, and the system hums along invisibly. But the repo market is also the leverage engine of the entire financial system. Because when institutions can borrow cash overnight against their collateral, they can use that cash to take leverage positions in every other market, including the COMEX paper silver futures market. The market where the price on your screen is actually set, not by physical supply and physical demand, by leveraged paper positions financed through the overnight repo market, taken by institutions that do not have never had, and never intend to take delivery of a single ounce of physical silver. And then there is rehypothecation. Say that word with me because it is the key to everything. Rehypothecation is the practice of using the same collateral multiple times. An institution borrows against treasury collateral, gets cash, uses that cash to take a silver futures position. That futures position becomes collateral for another loan. That loan funds another position, and so on until you have a leverage stack where the total paper claims on silver significantly exceed the physical silver that actually exists in any vault anywhere on Earth. The LBMA, the London Bullion Market Association, processes a reported daily volume of silver trading that when you do the math, when you take that daily volume and compare it against total annual global silver mine production, the daily paper trading volume in London alone exceeds what the entire planet digs out of the ground in a full year, every day. Think about what I just said. The amount of paper silver that trades in a single London session is greater than annual global mine supply. That is not price discovery. That is a pricing mechanism designed to produce whatever price the participants need on any given day. And today, on the eve of the most important Fed meeting of 2026, the price they needed was $79.57.